Today, I'm going to share with you my portfolio in CDP account. That's the one I'm building my own passive income through dividends. So whatever I mentioned today, don't see as a buy or sell recommendation. I'm purely doing this for education purposes, and hopefully it can inspire many of you to walk this journey of building up dividend income for your own retirement. So without further ado, let me share with you the first name that I have in my portfolio, which is actually Bowsteed Singapore. Now, I've held Bowsteed for quite a few years. My first video on it was like 3-4 years ago already. And that was when, during the pandemic, where Bowsteed actually made a lot of monies and contracts with their geospatial department. That actually benefits because they can actually show a lot of data points. And that is right now still Bowsteed's crown jewel. Bowsteed is recovering in share price and is doing pretty well right now. Personally, for myself, I've invested slightly more over the last few months into Bowsteed, and I'm pretty optimistic that it can break out from this $1.05 share price peak and break out to new all-time highs. Bowsteed right now pays around 5% of dividend yield, and I'm going to earn $3,520 if the projected dividends are 5.5 cents for this year. Second name of today is actually CapitaLand Investment. I'm going through with an alphabetical order. So CapitaLand Investment is something I acquired over the last few months only, and when it came down, I've actually shared that I've averaged in. The position right now is still pretty small, and the main reason I'm investing in CapitaLand, like what I shared previously, is because I want China exposure. CapitaLand Investment does have China properties. In fact, they're trying to move away from it and grow other segments a bit more. But more importantly, it's also the sponsor for many of our local REITs. So if China does well, and if REITs finally recover, in my opinion, CapitaLand Investment could be really undervalued. Dividend yield for right now is about 4.6%, and it's recently just paid this 12-cent dividend. I'm not including that dividend in specie, which is the CICT REIT, so I'm only counting the base dividend for this year. Total that I'll be earning for CapitaLand Investment will be $2,040 for this year. With that, let's move on to the third name, which is CapitaLand Escort Trust. I've held CapitaLand Escort Trust for a long while, since the pandemic, and as you can see, the price chart is not too favorable, correct? Personally, for myself, I'm a little bit disappointed. And just to share with you a story, when I was evaluating to invest more into Escort Trust or Booking.com, because I was really thinking about post-pandemic travel, I chose Escort Trust instead of Booking.com. If you see the price chart for Booking.com, you'll understand where I have my regrets. Booking has more than doubled, whereas Escort Trust has made new lows. So sometimes in investments, we do have regrets, we do have miscalculations, and I've always shared, as long as our wins are bigger than our losses or misses, that's all that matters. New investors tend to get overly worried about positions that are losing money or how fast can I make money. It's not the case. Investment is a marathon. As long as your winners are way bigger than your misses and losses, you would do really fine. Right now, Escort Trust pays around 7% dividend yield, but actually the latest dividends were cut slightly. If you're an Escort Trust shareholder, maybe I can give you this update. I projected to earn around 6.1 cents for this year only. I chose to keep Escort and let go of my Genting stock as my pure exposure to travel-related properties. Let's move on to the fourth name for today, which is another company that I have some regrets on. It's actually Delphi Limited. Now, Delphi, you may have heard of it when you see the chocolate, correct? They are still the dominant player in Indonesia. Back in 2023, Delphi seemed to be breaking new highs and going on a new growth trajectory. That was where I spotted it. Numbers look very sound, and that's where I started to get investments into it. But as you can see from the chart, something bad happened, correct? And let me share with you transparently what exactly transpired. Delphi sells chocolates, which means customers are end retail customers, and product cost or cost of goods sold is cocoa raw material price. Let me show you the cocoa price, and you realize that the cost of goods sold is now in bad shape, correct? Cocoa was once 2,000 plus US dollar per ton, but right now it's close to 9,000. So all cocoa manufacturers are seeing a reduction in profitability because cost of goods sold has surged up, Delphi included. Recently, they've cut their dividends also, which is not good news. I project their dividends for this year to be 3.6 cents, and I'll be earning 2,160. I am still holding on to it. Hopefully, cocoa prices can normalize. It's taken way too long, and the share price has punished. Again, this is a good story. We don't know what will happen to Mr. Market. It's important to have holding power. It's important to be diversified because adverse situations happen and the share price can turn against us. Then you may have this question, Josh, why didn't you cut loss on Delphi? Thinking back, I guess that if Delphi has lost its market share in Indonesia, then there will be a more urgent problem that may not be able to address. So as of now, they are still maintaining their lead. It's just a cost of goods sold problem, and I hope that things can revise for it. So with that, let's move on to the fifth name for today, which is something I've mentioned before in previous videos, and it's none other than Fraser Centerboy Trust. Fraser Centerboy Trust has finally recovered quite a bit. As you can see over here, in the 1 year chart, it's up already. In a recent video, which I'll leave towards the end of this also, I've shared that I've increased my holdings in Fraser Centerboy Trust through its right issue, and I've actually oversubscribed to purchase more of it at $2.05. Fraser Centerboy Trust, if you don't know about them, they own heartland malls such as Causeway Point, North Point, and also Next. Fraser Centerboy Trust, I'm expecting to earn $2,843 with a 12.1 cent projected dividend payout. Coming to here, if you have learned something already, help me smash the like button. It's taken our team hours to do up this presentation for you, and hopefully really can inspire you in your investment journey. So big thank you again, and remember to subscribe. Yes, and let's move on to the sixth name for today, which is iFast Corp. I started building positions in iFast in 2024, and that's because its profits were swelling up with good performance from its Hong Kong unit. But what do you know? In a small twist of events, its recent performance has showed a lower profit guidance for the Hong Kong department. Lowering of profit guidance is usually bad news. As you can guess, iFast share price plunged 12%. Not that it's going to losses, profit guidance have been correcting downwards due to increased cost. I will be tracking iFast closely. I'm very familiar with its platform. In fact, I use it for most of my private clients. And that's where the B2B segment of its business is very sticky. B2C, of course, there's a lot of competition. But B2B, which is where it works with advisors, is where it's building its books. I myself, I've also been building my books, as you can see in my asset under management with private clients. For iFast right now, I'm mainly investing in it for its growth. The dividend yield is only around 1%, and assuming it pays 6.4 cents for the year, I'm going to earn about $678. Let's move on to the seventh name for today, which is a household name that you may be familiar with. It's none other than Kim Lee. Kim Lee is one of the kings of Singapore coffee shops. You would see them across the island, and actually their share price has been trending in a tight range over the last few years. I can actually add a bit more flavor what is going on. In COVID period, they were skyrocketing because it's essential service, correct? They were growing their coffee shops and they were really optimizing profits. And in that period, government was giving a lot of grants, especially to help out with SMEs, and coffee shop operators like Kim Lee naturally stood to benefit. But as these subsidies started to wean off, employee net costs started to step up, and that's where the profitability saw a limitation in growth. Right now, Kim Lee is more like a cash cow with price earnings ratio of 12 times, pretty cheap for a very defensive sector, and dividend yield of around 6%. I am still waiting for Kim Lee to show its next growth leg, and if we assume a 2-cent dividend yield for the year, I will be earning $1,000 of dividend from Kim Lee. Let's move on to the eighth name for today, which is something I've mentioned many times on the channel. It's none other than Mapletree Industrial Trust. Mapletree Industrial Trust has fallen on hard times, and as an investor, I had to ride through thick and thin with it, correct? And even recently when there was a JP Morgan target price of 190, I stood firm with it. There are latest numbers from it, and let me do a quick sharing. The problem point seems to be US data centers for Mapletree Industrial Trust. Everything else in Singapore or Asia data centers are running well and growing in profitability. It's the US data center that's dragging the sentiment as well as dragging the overall share price down. And the JP Morgan report has highlighted the possibility of increased non-renewals, which also means a drop in profit. So the number to track is this left-hand side, 89.9% occupancy rate for data centers. This needs to stop bleeding for sentiment to reverse. And that's why for dividend growth, it has yet again stalled, with the latest figure at 3.36 cents for fourth quarter. Total dividends for the year is 13.57 cents. And although I'm optimistic that this could grow, I'll use it conservatively, and my expectation is a $6,035 of dividends from Mapletree Industrial Trust. Coming in at number 9 is another Mapletree REIT. We are going alphabetical order, correct? And you can guess it's Mapletree Pan Asia Commercial Trust, MPACT. If you see a share price, you realize REITs are seeing still some headwind. Worst could be over already, but growth, we still need certain catalysts for the sentiment to reverse. MPACT is something that I've cut losses on, and shared in this previous video. And the reason is because I think the Festival Walk, which is this Hong Kong mall, is still seeing some problems that can't be overcome yet. That is why when I see such an article, I think it makes a bit of sense. MPACT should explore merger or sale of Festival Walk to become more Singapore-centric. Right now, it trades with the worst valuation among STI constituent REITs. As of now, the sentiment for Festival Walk is quite depressed. I don't know if selling it right now makes a lot of sense because you can't get a very good offer for it, correct? But on the flip side, there are a lot of reports that say that Hong Kongers are going to Shenzhen a lot more. And when will footfall and revenue recover for Festival Walk? It's still a very big question mark. So I think this idea would not likely take place in the short term, but it's something that parent can reconsider. Because if we see in terms of the profitability, latest figures suggest yet another shrinking of profits from Festival Walk. That is a yellow bar over there with 37.7 million of net property income contribution. Actually, headwinds are not only from the Festival Walk. In a previous video, I shared that Japanese property, which is the turquoise one there, is looking problematic. That is why I actually cut losses on it. I moved some of the money to something I'll be covering in a quick while, so hang on for it. And in this chart, I'd like to highlight also that Mapletree Business City, MBC, has been sliding for a couple of quarters really. I think analysts should start to flag whether there's concerns of it because it used to be a crown jewel. The numbers on the other hand are not supporting it. The only thing that seems very dependable is Vivo City. So MPACT looks to be like one solid star player and everybody just not doing its part. I am a bit worried about it, and that's why I'm forecasting a very conservative 7.8 cents, which will equate to about $1,770 in dividends. Coming to here, if you have questions or comments, leave them in the sections below. Let me know your thoughts and what are your favorite picks so far covered. And with that, let's move on to the 10th name for today, which is actually a company that you may not have heard of. I've covered before in a previous episode many years back, so I've been sharing my journey for a long time as you can see. And this is none other than Malaysia Smelting Corporation Berhad. What does MSC exactly own? Very simple. Tin mining. Is tin mining very sexy? Absolutely not. But what they serve is actually very sexy industries, which includes semiconductors. Tin is a very important mineral that is used there and also in batteries for electric cars. The profitability for owning a tin miner depends on the tin price, correct? And right now you can see tin prices are still fairly strong. But when I show you this chart, I actually want to share with you a story. I missed out the chance to sell it back in 2022. That was when tin prices skyrocketed and Mr. Market was offering me $1.50. I held on to it expecting a much bigger price, but right now it's fallen to a price closer to when I started acquiring it. So a missed chance to exit with a big gain, but nonetheless it still provides some dividends, which is about 14 Malaysian cents. Dividends expected are about $1,275. Let's move on to the 11th name for today, which is a company that you're probably familiar with, and it's none other than Propnex. I sold away some of MPACT to buy into Propnex, and the reason, when I realized that new launches were super hot. Third quarter last year was a bang. In fact, showrooms are still selling very well, although I've heard one marina not doing that fantastic. But all in all, when showrooms are filled, people are buying properties. Propnex as a real estate agency makes a lot of money. Right now, Propnex is back to this trading range around $1.10. And actually, if you factor back the 6 cents of normal dividend, it still sits at that band. I'm not even factoring its special dividend. And with that, I'm projecting to earn $5,580 purely from Propnex dividend. Hopefully this continues to run well, and Propnex right now is one of my biggest positions. Speaking of positions, I've added something new to the list. Something I've covered many times on the channel indirectly, and it's also a household name that if you live in Singapore, you definitely know. The 12th name I have for today is actually Sheng Siong. Sheng Siong is this very hardy business that if there's a recession, if there's a pandemic, it doesn't quite get affected. The problem is usually on growth. So I've always kept tabs with it. Not that growth has suddenly turned spectacular, but Mr. Market suddenly gave it a way bigger multiple. And I realized that in mid of April. That's why I acquired a small stake into Sheng Siong. And with its latest results on 29 April, you see a share price continue to trend upwards. Revenues have grown, but the impressive part is its gross profit margin of 30.3%. It is not easy to make money in supermarket. That's why Cold Storage and Giant actually sold out at a relative cheap price. Quite obviously, they weren't as profitable in gross margins. And as of now, Sheng Siong has continued to grow its earnings per share, and that in itself will allow a higher dividend payout. I am expecting a $320 dividend payout from Sheng Siong, and hopefully this can continue to grow. I have one final name on today's list, which is a real estate developer and also the parent company of Malaysia's Smelting Corporation Berhad, and this company is Straits Trading. Real estate companies are really depressed in valuations in Singapore. When will it turn? I also have no idea. I bought in Straits Trading viewing it as undervalued, and in many ways maybe this can be seen as a value trap. But since I'm inside already, I'm holding on to them. Dividend yield for Straits Trading right now is about 5.4%, and my projections for it conservatively is 8 cents of dividend. With that, they'll pay me $1,950 for the year. So all in all, I have 13 names on today's list. Actually, there's one more name that doesn't pay dividend, which is BYD. I built out stake in BYD, so you can see it's a process of accumulating good businesses at good valuations. Some we get right, some we get wrong. And in the meanwhile, we are still paid a dividend. So all in all these 13 names that are paying me dividends, I would earn a grand total of $31,001 for the year ahead. That is not too bad. That's about $2,500 per month average, right, in dividends yield. And when I build retirement ladders, if I can build for myself $2,500, I think that's pretty good already, considering I still have some runway to my own retirement. But in this process, I'm also enjoying seeing it grow. And right now the portfolio value is around $646,000. Quite a consistent building process, and let's see how far I can build this with. So as always, if you'd like to follow me in my journey, smash the subscribe. And again, hopefully I've inspired you in your journey too. Thank you very much for sticking with me right to the very end. And with that, I would like to introduce you to some of my previous video. This one shows on why I've cut losses in MPACT and bought PropNext. And this one actually shows on Fraser Centremoy Trust, which is one of the REITs I've covered for today. With that, I'll sign off from me and see you in either of these. Take care as always. Goodbye.